Everybody, Francis here. I graduated in 2020, so not many years ago. I was sitting right over there. I'm really excited to share some of the things that we've built over the years from our experience. And some of the ideas are actually inspired when I was a student here. What I want to cover today is beyond just simple AI stuff that you can see on LinkedIn. I'm tired of the AI slopes. I hope you do as well. But something that we have seen at the very frontier of the adoption and what's going to come to the entire capital deployment process and our conviction and prediction. So that's what I want to share today. So who we are, Apers initially was a research project when I was a student here. So that was called Autonomous Private Equity Research Systems. The whole goal was to create ultra lean platform with highest AUM, because we know in public equities, it has been there for 40 years ago. So that was a general trend that I had in mind. But of course, the name was too long to be a company's name. So we used the acronym Apers and turned that whole thing into a company 2 years ago. And our whole mission is really to make capital think. So that's what we do, long story short. And before I move forward, I just want to do a quick poll. Who doesn't know cap rates? Are all good? We're going to cover a lot of institutional things. So I want to make sure everybody understands this or sleep really well. So one of them. Okay, what I want to cover right now is typically when we look at the real estate private equity, even the endowment, the LPs, the traditional financial institution that we see is still human-based, believe it or not. So at LP level, they have the portfolio construction committee determining the allocation percentage. At the GP level, you have investment committee making decisions collectively. The whole thing that we had initially was like, what if we can make capital think for itself? And we even coined a term, it's called autonomous financial institutions. It's just a fancier way to say, if we can automate as much as the decisions as possible, how far can we push the whole industry? So in this talk, I want to cover 3 points. 1, why this is emerging now. 2, what it means for institutional real estate specifically. And 3, what about us as a human beings, as a new grads who are entering into the labor force? What does it even mean to us? So that's the thing I want to cover. So we believe autonomous institution is inevitable. And by autonomous, we mean it's more Tesla driving. You still have someone taking the wheel, still have somebody overseeing the process, but largely the process is automated. So that's what we mean by autonomy. And we want to start with a very simple calculation. I assume everybody's familiar with the business model of a private equity firm. They raise some money, they charge a fee, they hire a bunch of people, they start finding opportunities and they make calculated bet. And hopefully, when the fund is over, they can make some money. And let's just assume we have a $2 billion fund and that'll be 2%, pretty standard term. You have 30 people. If we switch it half from analysts to managing partners, so imagine you start a platform tomorrow, people, the salaries, are essentially our operating expense in a way. And there is a problem. The problem is the operating leverage for a cyclical industry. So sometimes we have really good time, like 2020, free money everywhere, like cap rate 2% going in, why not? Sometimes we had really bad time, like 2025 laugh, ask Tishman ERC about their vacancy and they will delete you on your LinkedIn right away. So that's the nature of the industry. And that put a very huge operating leverage to the GP firm level. So that's what we see the structural problem for the GP layer. And there is actually the backward economics, because essentially LP is allocating capital. GP essentially is right here, is taking the operational risk, which is, I would say, extremely enlarged the risk GPs are taking. So what could be the alternative? And this is, to be honest, this is the most fundamental cornerstone of everything we're doing here in terms of replacing, I would say, low economic value labor with technology, because we can lower the operational leverage. Compute can be on demand. Human laborers cannot. So that's the biggest, I would say, the pain point that one is talking about. Because if you say that, how can you hire talents? We're going to fire you when things go south. That would be something very interesting. On top of that, diminishing return of labor. So managing a 10 people team is very different from managing 10,000 people. And that there's a huge diminishing return, even for Blackstone today. They have 4,000 people across the globe. It's really difficult to manage that. Even they have the global Monday investment meeting. It's really hard to manage such a huge team. If we switch our hat a little bit, so put our hat to the CalPERS CIO, essentially we're managing a portfolio, the wealth of a nation or the pension payer. And our decision is, okay, we're allocating 5 to 10% of our portfolio to this asset class. We have certain conviction at portfolio level. Who's the most efficient layer to deploy the capital among the 5 to 10%? And what's the cost to get this exposure? The cost is more than just, of course, fees. So 220, that's a standard. Maybe Blackstone is charging that. Peggy and I start a new fund. We charge 0.5 and the 10%. Probably we're not going to be able to compete with Blackstone because we're new. We don't have track record, so higher risk. However, there is a fundamental thing that in capitalism, that is, if they're providing the same service, the lower cost will take the large market share. So if Blackstone and Brookfield, they have a similar fund product, Brookfield is charging lower. Most likely it's going to be more attractive compared to Blackstone's product. And if we summarize that, capital flows to more efficient structure, economics 101. That is why we coined the term, make a capital thing. So this is the economic foundation for removing or minimizing the organizational friction overhead. It's essentially improving the capital deployment efficiency. So that's the foundation of everything we see today for the enterprise-grade AI system. That is the whole goal here, removing friction, make the capital more efficiently deployed. Okay, so this is a real estate talk, so we want to be more specific to real estate. And why we started the real estate, because there are so many asset classes, like public equity, venture capital, all kinds of things. It turns out real estate has a pretty structured and repetitive analytical workflow. So everybody who has done private equity or even developer know the process. There's a deal, there's certain information, you somehow convert that into NOI or expected NOI given your value add strategy. You probably get some cap rate compared to the cost of capital, structure the financing, and then you do the deal and hopefully it's positive. You can get some carry out of it. It's very different when you look at different asset class, like venture capital. So there, basically, I would say lottery with positive expected return. They make friends by founders dinners, and hopefully they can have a unicorn by luck or by whatever. On the other hand, for distressed credit, so when you are pure M&A private equity shop, basically it's a la carte. Everything is different. You really need to be creative in terms of turn around a company, bespoke situation. You cannot reuse the playbook you somehow created last time. Real estate has a lot of unstructured data, but at its core is what we call algorithmic. So it can be automated. It's just hard previously. On the other hand, if we move forward, so we have heard like real estate is people's business, you make friends, relationship. But if we switch the lens to an engineering perspective, it's just there are certain unobservable data that you have and other people don't have. So you are a more efficient layer to deploy the capital because you can make a better risk-adjusted decision. But looking back for the past 10 to 20 years, like CoStar, Reonomy, Cherry, Altus, even MICN, who bought, I think, RCA, the data infrastructure is already here. And the proprietary deal flow is the modus. It's still there, but it's no longer 30 years ago. You know the owner, the family business. You're the only one who can convince them. And then you bring Morgan Stanley Real Estate and buy their asset. We're no longer in 1990s. And what it remains, to be honest, is just speed and analytical capacity. Can you make the best risk-adjusted decisions in general, overall, in the long run? And finally, asset allocation in terms of the pressure is getting higher and higher. So back in the 1990s, real estate was considered Main Street. When you talk about cash flow, people think about fixed income. And then you say real estate can be a really good alternative to a pension fund for their asset liability management. Great. Who's going to do the fund structure? And then we have Blackstone. And they charged 2 to 3%. That was reasonable. But as we are in 2026, the competition is getting more and more fierce at the GP level. And probably one of you guys might think about starting your own shop. So the competition is there. And in terms of competition, it's really about price. And the price at the GP layer is the cost of fund management. 2%, 2020 is getting harder and harder to be justified as we are moving forward. This is what we expect the newer version or the future version of the structure at the GP level, because essentially we're just a bunch of people making smart decisions. Hopefully we can find a deal and charge minimal money to the LP so we can have a more aligned interest, higher realized return. And the trend we're seeing here is it's really getting smaller and smaller. We call it boutique firms with AUM between half a billion to 2 billion. That's the sweet spot. They have a small team, usually 2 to 3 senior partners. Most likely they went to HBS or Goldman or Blackstone. They are starting their own thing. They have no legacy. And that's the trend we're seeing. High AUM, very few people, plus all kinds of automation. And AI is just a term for the trend right now, but that's overall the process that we observe. Yeah, so right now, in terms of the talent, we observe this as well. It's like you really don't need so many people doing the transcribing PDF, scan PDF to the waterfall structure. You really don't need that anymore. However, given the technology today is not perfect, so you still need people to be part of that. More like architect, system architect, engineer, compared to the traditional junior roles that we see 20 years ago. Part 3 is like 2026, what now? What I want to do right now is I want to show a demo of how far the technology has come. And the task I'll be showing is just imagine we have an LPA, which contains certain waterfall structure. We have a pro forma already, and we want to build a model on top of that using the legal paragraph. And this is essentially the core analytical work. And typically, when I was in private equity firm, that took me 4 to 6 hours. When I'm having enough coffee, longer if I'm not. So let me just show you right here. Oh. So I recorded the whole thing because it took about 10 minutes. However, you can try it out yourself anytime. So imagine, look at this. It's just like typical waterfall structure, and that's a legal language. Take a screenshot using the vision capability of the AI system, and that is the pro forma. What we want to do is turn the legal language incorporate that into the model. So essentially right now we're reasoning with the AI system, and you can see the actions there. So we just want to build a simple one, and the system will ask how we want to do that. Do we want to update certain cells? These are the content we want to put into a spreadsheet, and the system will just updating that one by one. And the approval, disapproval, or always approve is essentially what the future roles will look like. We're making the approval decision or correct certain input that the AI system is making. So it's going to take a few minutes, which I've speeded up a little bit. And the whole thing is really dynamic models that we typically build in spreadsheet. And you can notice sometimes AI is confused. So it attempted to do something and failed to do that. And it tried again. So the autonomy is already there, looking through the model, seeing what's going on and what went wrong. What I want to show everybody is when the model is making certain circular reference mistake, which I made a lot when I was in my first year. It's going to be here really quickly. So let's just wait for a few seconds so you can see all the formulas. Let's just give a few seconds. We have a lot of ref. Yeah, circular reference. Yeah, this is how we correct the error. We essentially observe that, hey, what the fuck, we want to correct the error. And turns out the system can understand, yeah, turns out that's a circular reference. And we're asking the system to update those errors. So it still takes time. Sometimes it fails to acknowledge the error. I know sometimes we need to be explicit. Right here, for example, in row 38, so all the refs are there. And then, AI system looks, yeah, shit, I made a mistake. And there are certain sections, you see, there are more refs over there. It's because the AI system is balancing the compute it uses to see the entire spreadsheet and the certain sections. So it saw that part, correct that part, but certain parts are missed out. So we need to explicitly tell AI, go there, fix that, and then just move forward again and again. We have certain mistakes there, fix the circular reference. Yeah, and then we have the model and using spreadsheet. The whole thing was about 400 seconds, But still, that's way faster than 4 hours that I used to spend. And I used to go back and forth with my MD. So that's just a quick demo of how far this has become. And in addition to that is how fast the technology has evolved, because it wasn't possible 6 months ago. So everything we're seeing today was built in the past 6 months. It wasn't possible either because the compute is very expensive. We call dollar per million tokens. It's very expensive. Or the context window is just too short to process spreadsheet efficiently. You can only process CSV, not spreadsheet. Or it's because certain AI agent we call infrastructure is not there, like the approval, disapproval process was not possible 6 months ago. Now it's already possible, and you can access to that like right now on your computer. What I want to show everybody here is the key moments in the demo process. Number one, the whole process could be autonomous if we click always approve. So you can just let it go. It's just on autopilot mode. But there are still certain parts that require our human attention. So it can make a mistake. It's much like a junior analyst. Sometimes there's some errors. It can be a really nice model. Sometimes just tiny errors can crush our model. And the goal here for us is we can see the shift of roles. We're turning into manager of a system, seeing where things go wrong, make sure you can fix that, and then make sure it's fast enough. And finally, there are 3 implications. Number one, from firms to protocols. If we look back, what are GPs selling eventually? It's the first principle. What are they selling? Are they selling a bunch of analysts doing the transcribing of PDFs? Probably not. They're selling a unique insight of the market, something the LPs cannot buy. They're selling a conviction that they can deliver, they can execute. But essentially, that conviction and the insight is the reason why they're charging 2%, 20%. We're just getting pure and pure to that. Other than that, their operating expense, it should be minimized. We have 2 more implications, and we'll be having the Q&A. Yeah. And there is precedent, a lot actually, like public equity. 50 years ago, if you want to deploy in public equity, usually you'll find public equity manager. They're like a K-pop star. They go out go on TV, magazine, right? But now we see the whole process of a Vanguard and BlackRock. We call factorizing the asset class. So you can have ETFs, like 3 basis points getting the U.S. equity exposure that wasn't even like imaginable 40 years ago. But this is already here. VTI, buy it, 3 basis points. That's it. The same thing is happening to institutional real estate. It's just slow, but it's finally here. Implication number 2, alpha, because we're in the equity game and we still want to make sure we can deliver alpha instead of buying REIT or the ETF of REIT. We believe the future of the alpha will be 1, proprietary access. Certain markets still have the accessibility challenge. If Peggy and I start a fund, we want to go to Thailand and do opportunistic investing. Probably not. I don't even speak that language. Number 2, parameter tuning. That's essentially converting our belief of the market into numbers, and then we can make more informed or better risk-adjusted decisions. And then, of course, structured creativity. Opportunistic fund, distressed opportunity. You will be amazed by what kind of legal contract they sign to get the money, and then waiting for you to be the problem solver as the distressed investors. So that part is really hard. It requires a lot of heterogeneous decisions. Yeah, and in terms of the surviving analyst, so we believe the next version of the best analyst is going to be the one who tastes relationships and edge case judgment. So they can solve problems, deliver more productivity. Compared to the traditional model like 20 years ago, essentially we're asking the employers to take certain cost to train the analyst. They are essentially doing the training, paying for that. That could be the history, most likely. And finally, the fiduciary question. This is a question we don't have an answer yet. The system is great. So when things go south, who's going to be responsible for that? Traditionally, we have the investment committee decision making. So that's collective decision, even at GP and LP level, both of them. But as we progress to the newer model, so when we have the algorithm flags deal, when we have human review summary, human says yes, and then execute, who's going to be responsible for the bad deals? That's the question to be answered. We don't have a really good one because AI native PE shops are still nascent. So that's a question I want to leave to everybody. 3 takeaways. 1 is inevitable because the capital will flow to more efficient layers. anyone who's fighting against that usually don't go well. So lower cost, more efficient, that's the way to go. 2, structural. Make capital think means removing organization layer. And we believe the winning one will be the one who's more like a boutique firm adopting that from day one instead of large shops and subscribe Microsoft Copilot and call it a day, praise themselves during the investor meeting. Q2, probably not. And career bet. So if I were to graduate today, what am I going to bet on? Probably either be a algorithmic auditor, like I can work with the system really well. So I unlock the productivity of the shop, like 10x or 100x. And the veterans probably don't have the experience like I have. Or be like super, super good at building relationship or creativity in terms of a different kind of deals, more exotic deals. But the middle part is disappearing for sure. And the closing remark that I prepare is, if we look back to 200 years of the industrial revolution and capitalism history, 2026 is a very interesting year. And we gotta say it is an inflection point. The cost, the technology, the engineering are finally here to make the mission of Make Capital Think possible. And I hope you guys are as excited as we are that tomorrow will look very different.